Today, we're going to look at the best new technical analysis indicators. All right, I'm going to mix in a few old ones, okay? Now, there's an investor's dilemma. On the one side, the brain knows that risk management is the key because you got to have good risk management to survive. But the gut tells them that it's all about finding the right entry signal, which usually gets connected with the right system. Now, when they reach the pot of gold at the end of the rainbow, they find that it's really filled with great entry signals and systems that provide excellent risk management. So let's take a look. So when people first start out, they learn about things like lagging indicators, and lagging indicators are kind of interesting. Here's a simple one. It's a crossover technology. And simply when the blue line goes over the red line is a buy, and when the blue line goes under the red line, it's an exit, and goes above the blue line again. The blue line goes above the red line again, it's a buy, and under it is an exit. And in some runs, like this one here, it does pretty well. And it gets a little chopped up and maybe even takes a few small losses in areas like here. So what people do is they start looking at other things, something a little more sophisticated or better, or, in order to improve performance. And so they run across oscillators, and this is stochastics, and down here is oversold, and over here is overbought. And if you know George Lane, if you ever met him like I have, he'd tell you something interesting that I'm going to add in the next frame. And so the problem with adding, just using this as an overbought, is that you might get out here and miss this whole nice run here, right? But over here is oversold, so you wind up getting in here, and now it comes down again even lower, because it never goes up into overbought, and I don't know. This can be kind of bad for the stomach, if you know what I mean. So so much for that. Let's see if we can prove that a little bit. Maybe using something that George Lane said. Well, one of the things you can do is that when this overbought indicator is way nice up there in the overbought, and you see a buy using the crossover moving average, you use it. And then you go along until you have an exit, boom, and you're out, ignoring these ups and downs in betweens. And then when you finally, then you're out, okay? So when you finally get another time that you're in the overbought, like, well, maybe over here, you buy again, and you stay in until you have an exit, like over here. Okay. And so you wait until you have another buy and overbought, but you make sure that you're in the, your buys are only taken when things are in overbought. See? And sticks around until the exit, which might be over here. And then there's another buy, which if you see here, see this is an overbought? See how it nicely goes up here? Well, that looks pretty cool, doesn't it? That might be a little better. So what you do is you do something called a walk forward, right? And a walk forward means you develop it on old data, like this is 2004, 2005, 6, 7. Then you walk forward. And here's 2008, and you see what happened there, right? And you see in 2008, there was the high, and it got you out. And it went down. You never got long until way over here, and it was an overbought, and you had a buy signal, and away she went. Got out here, and here was another buy a few weeks later. And then up she went, really nice. And here was another exit. And prices Went down, around, and mulled around here for ways and all that kind of stuff. And came over to here and noticed when this buy was over here, things were in overbought. Oh, time to go long again. That looked pretty good, right? So let's see. And here's a further walk forward. Well, this further walk forward seems okay. Heck, right now is April and 2014. That seems to be doing okay then. So essentially, the concept is you ignore the overbought, oversold oscillator, except when you have a buy signal, and you only take buy signals when it's in overbought. Okay. Now, of course, there is a little danger with that, and you need to know about that ahead of time. And that after you do this, the test and the walk forward for 6-7 years, like most people do, then take it back on a whole bunch of data way back as far as you can, and see if there's other times when it was a little scarier and what that was like. Here's an example. Here's a buy in 86. Came up here, things are nice, and boom. And it wouldn't have gotten out until over here. Then probably had another buy somewhere out there, but would have participated in this massive down move. And so you got to know that ahead of time, right? Now, I know because I saw it right here in 1987 in October. There were some things that gave you short signals in something called using Andrews techniques. So let's take a look at some of those. Those are a little different. They're called market geometry. And let's see what that's like. Well, so the question comes up, are there better techniques? Now let's take a look and see what was posted on CNN, because they have a habit of time stamping things so you know what was said when or posted when. And this particular chart here says the fattest lady has sun. And what they're alluding to, they're pointing to, is the financial sector index or fund, and saying that this high here, using this geometric line, indicates that that's it, folks. Down she goes on a daily chart. Well, anybody can draw a line like this. The trick is knowing when to draw the line, because most of the time it's just a line. But when is that line actually useful? Okay, well, let's take a look and see what actually happened, because this was posted on March 21st. At the time, this high was here. Sure enough, prices went up to here and they kind of bounced around and went down rather nicely. Here was March 21st. Same one, financial sector fund. Okay. Apparently they knew how to draw the straight line, which most people can do, but when to use that, that's the key. And so then there's this other indicator called the Andrews Pitchfork, the new Andrews Pitchfork indicator, NAPI. And this one also on CNN here, posted April 14th. And this one talks about a rally. And here, apparently, there's a 4, a value of 4. And the values that get posted are 1, 2, 3, or 4. And so this one has a 4 here, and suggesting that it's going to be a nice, strong up move. And we can see here was a 4, another 4, down move. And here was a 3, and a down move. And here was a 3, and a nice up move. And this is something else. It says values over a period of time are cumulative. And when there's a whole bunch, so one was 1 and 2 and 1. Ooh, that's 5. That's powerful. And up we go, right? And so this 1, 1, 3, I guess you add those together and powerful, down we go. So that's kind of how that works. Let's take a look and let's see what actually happened. Yep. there we go. It went up quite a bit. Okay. Well, apparently this oscillator, that's not an oscillator, it's an indicator, and you can see it usually posted at the end of the day. If you want the early indication of it, you need to join a group, but the end of day, if there's a change, is available on the website, which is called andrewspitchfork.com. No charge. Now, we've seen this done on longer term charts for kind of weeks, and we've seen it done on daily things, what's going to happen the next few days. Can this be done for a shorter time period? Say 15 minutes. And I think they answer the question here. This was posted on March 7th, 2014. And we can see on this bar here, the high value is 16505.7. And this is the Dow Jones Industrial Average, not something that can be manipulated, right? And here we go. And this here was March 7th. Still, that was the high. And down she went. And these are all 15-minute bars. That's pretty nifty, isn't it? There's a technology out there that can do that. Wouldn't that be nice to know? I mean, would it give you a leg up or an edge? Well, who invented this? Well, apparently it was Roger Babson. He's also known as the founder of Babson Business College in Massachusetts, one of the premier business colleges, and his associate, Alan Hall Andrews. So who teaches this? Well, here's Dr. Alan Hall Andrews. There's a video, apparently, of him teaching at a live seminar down in Miami. And he's drawing these lines that seem easy enough to draw. It's just a matter of knowing when to use them. So Dr. Andrews is kind of getting on in his years. Is there someone younger? Who is this person here that's teaching this concept that they're talking about at this seminar? He's the one behind andrewscourse.com. And you know what's kind of neat? If you go over here and you click on New, you can type in your email address at two different places. One place gets you an email like once a week, and one gets you an email like a couple of times a week. And you know what else is neat? You can click on Products, and apparently there's two different ones listed there. One is the Advanced Andrews course, and one is the Expanded Andrews course. And the Expanded Andrews course is a massive amount of information. That'll take you a while to go through. And it goes into all the writings of Andrews, and even the regular Andrews course the Advanced Andrews course has like 25 videos that show you how to do all these different things that are very different from what most people think the Andrews techniques are. And then there's this private group, and in the private group they get the information on the new Andrews pitchfork indicator early in the morning rather than late in the day, you know. Okay. Now, one of the considerations is, will they stop teaching it soon? And here's why. The answer is quite possibly, because they're now working on developing new software that will take over the analysis of what's being done today by individuals. And the new software will have various signals, and it'll manage the trading, and it'll use the Andrews techniques in a way that Andrews used them in his head. You see, he used to send out this thing called the orders indicated on a Thursday or Friday. So it'd get to his readers on Monday, and they would read this script to their broker verbatim. And he'd publish this, and if you get the expanded course material, you can read through it, you see it for yourself. And it's mind-boggling what he was able to do, because he would give the orders ahead of time, and then he would track how much that would make. And apparently his tracking showed that over a few months he took 5,000 and turned it into 50,000 back, oh, many years ago in the futures markets. So that's pretty cool. Now, how can you test this out for yourself? Well, what I think is useful is to go get one of those free services, or even pay for one like we did here, where you type in your orders on a daily basis, and then you can see a pretty little chart, and you see a little listing like this here, and you test out how well you're learning it. Okay, and here, for example, you can see these are trades that are doing okay. Apparently, this was started back in April sometime, and here you can. It's probably the 15th of April, because this is the last trade in here. This is a natural gas trade. So let's keep an eye on the Australian dollar trade here and the natural gas trade here, because the other ones are going to change. Watch what happens. Well, here's the chart, first of all, of the activity that was taking place there. Okay, has its ups and downs. This is the month of April, and there's two lines. One line is with commissions and one is without. Okay, and you see the Australian dollar is now gone from the red and now into the green. Huh. And natural gas is still kind of hanging out. And the other ones, there's a few missing and a few new ones there. Some red, some green. Just keep typing them in, typing in the orders, and this way you can get a feel for what it feels like to do this on a daily basis before you put real money on the line. Okay? It's important to have that sense. And just keep putting in the buys and sells. Here's our old friend, the Australian dollar again. Now the profit is only 20 bucks. Let's see, it went from the red to being nicely in the green and down to 20 bucks. Oh, well, that happens. And you got a whole bunch of things in a whole bunch of other things. Let's see how our old friend, the natural gas, is doing. Well, it's still down there. It's up 440 bucks. Just sitting there doing a lot of nothing. And here you can see the chart. Still has all those ups and downs, but this guy's gone up a bit. So this one's not doing so bad. And here you see another one. And natural gas now is, ooh, that's up nicely. As is the Australian dollar. It's up a bit more, not fantastic, but it's got a few red things in there. And yeah. But let's see how the overall thing is done, because remember that a lot of the positions that were on the other one I showed you are now gone. Ah, chart's doing pretty. So remember, it's important to kind of test it out, because that's the newest and greatest thing. So this way you get a feel for what that's like before you go out there in the real market and do it. Okay? And put the real money on the line. And what's nice about these kind of services, especially the ones you pay for, is that you can't cheat. You can't just have a do-over, cheat it, or change these numbers. I changed my mind. I shouldn't have bought yesterday. None of that stuff allowed. It's just like the real thing. Okay? So that's all I've got to show you today. Hope you enjoyed seeing the latest and the greatest, the best that's out there. Bye.